All right. Happy Tuesday, everyone. Glad that you could join us today. My name is Mark Beal. We've also got Kenny here as well. Hey, Kenny.
Hey, buddy. You
Uh,
doing good?
Doing great. Doing great. I hope that you are as well. And want to say thanks to everyone who joined us today. I see a lot of repeat customers. So hopefully you're finding this information really valuable that we're putting out to you. And we do appreciate your time here today. If you are interested in reviewing this information after the fact, or for someone who may not be able to join us live, this will be available for playback as well. And so just a quick housekeeping item. If you would please double check to ensure that that you are muted and that your video is also turned off, unless perhaps you just want us looking at you. So just we'll throw that out there. And with that, we'll get started. So today's topic is one of our advanced planning topics, and we're going to talk about tax deferred savings. And this is the next step in our ongoing series, which we've been putting together. And just as a reminder, what we've been doing is putting out what we call our Bear Facts Friday. That's a quick weekly recap that comes out every Friday morning, typically just 5 minutes or so, where we talk about a big thing that happened that week. And then we give you some ideas as far as keeping things in perspective, as well as some wisdom during this Corona time that we're experiencing. And then in addition to that, every other week we've been doing a webinar like we're doing right now. And so these are some of our past webinars that we've done. We hope you're enjoying all that, as I said, but all of it can also be found on our website there at the bottom, bearwealth.com/bear news. You can go back, review it, and certainly share it with your friends and those in your network. Um, for those of you who have joined us before, or maybe if you're new, this is what we call our financial success matrix, and it's the basis for everything that we're going through with you on a week-to-week basis, and for our clients on a long-term basis. And it consists of three different parts. The first part is actually at the bottom. That's our financial planning foundations. In our first webinar related to the foundations, we talked about an emergency fund. That was a really great one. Our next one, we moved up to investments, where we did investments 101. And then today we're presenting on our first advanced planning topic, which, as I mentioned, is tax deferred savings. And so each of you out there, whether you're a client of ours or not, each of you has this financial success matrix. Maybe it's more complete or more robust than it needs to be. But this is how we think that you should look to help structure your financial lives to ensure success. Just quickly, as far as what that is, I think we touched on that. You know, the foundation of anything is the most important part. In financial planning, that's so true as well. You can't get around it. So building a foundation is of utmost importance. Then we put a big attention on investments. That's obviously very important as well. And then advanced planning. So that's kind of where we are and how we're going through this process with you. But with that, we'll get started on today's topic, talking about tax deferred savings and the advantages to it.
Yeah, appreciate that, Mark. So, I mean, I think laying out this foundation, this whole series is about, it's about the blocking and tackling, and we're building, and you build upon that. You know, you got to learn to walk before you can run, I think the old saying goes. And, you know, going to to me, this is really sort of the basics of advanced planning, talking about the advantages of tax advantaged retirement accounts. And I think that we all hear over the course of our lives have heard about, well, you want to save in your 401k plan, you want to save in an IRA, you want to save in a Roth IRA, whatever it may be. And I want to illustrate why, like really the hard facts about why investing in any sort of tax advantage vehicle is going to give you a better result down the road. And we did some calculations just before we got started, and they look as such, right? So you have a pre-tax investment of $100,000. When you invest $100,000 pre-tax, you make $100,000. You put that $100,000 to go straight into the retirement plan. You don't have to pay taxes on it first. It's going in, you know, hence pre-tax. Let's assume you add $10,000 each year into this retirement plan. That again is pre-tax. You're getting it, it's going straight to your paycheck. You don't have to pay income taxes on it, so you get a lesser amount. All right. After tax, if you have $100,000 and you haven't paid taxes on it, and you're in a 35% tax bracket, well, what do you have left? You've got $65,000 left. So now I get to invest $65,000, and then each year thereafter, I'm going to invest not $10,000 because I got to pay taxes on that $10,000. I'm going to invest $6,500. All right. So those are the assumptions we're making here are a 35% tax bracket, and the money's going to grow at 8% over a 20-year time frame. So let's see what really is that advantage. The advantage is $448,000 over the course of 20 years. And that is, why is that the advantage? One, you get that 100 grand, so you're having more money at the start versus 65,000 because you don't have to pay taxes on it. And then that money is growing each year tax deferred. So you start here, the money's growing tax deferred over time, and you don't have to pay taxes on it until you start to withdraw it. So obviously this isn't apples to apples because you've paid taxes on some of that growth, and the money that I show there, that $475,000, is actually the money that's already been taxed. So you've got $475,000. The $923,000 is before tax. But if you were to cash out that entire $923,000 and put it in your pocket, you at the 35% bracket, you would actually still have $600,000 left versus $475,000 left. And so that shows you the advantage of, one, having money invested pre-tax, obviously, and then two, having that money grow tax deferred, because you don't pay any taxes on any of that growth over the 20 years that we illustrated here. As to where in a after tax account, you pay taxes on that money every year. Some years you might have to pay more than others. Some years you might pay less. Some years you might not pay any at all because all you did was lose money in it. But over time, over year, there are taxes to be paid on that money from from this year to the next year. There's going to be some, whether it's dividends, interest, income, what have you. And it just shows at the end of the day, you're going to end up with more money by putting your money in a tax advantage retirement vehicle. There's a reason why there are different rules and regulations. I'm sure most of you are aware. You can't pull the money out to your 59 and a half without paying penalty. And there's different stipulations. The reason why those are there is because it's better for you. It's advantageous because you'll end up paying less taxes and you'll have more money at the end of the day. And always, when it comes to investing, when it comes to retirement, when it comes to pretty much anything, it's not what you make, it's what you actually get to keep. And in the advantage, in the illustration, the example I gave here, putting your money in a tax deferred account, tax advantage savings, you have more money to keep at the end of the day.
So Kenny, I got a question because I think you make some really good points there. If we're talking about the after-tax investment amount, in this case, $475,000, you mentioned something where, well, you've got to pay the taxes along the way. And for our listeners out there, maybe let's give them a little bit more idea of what that looks like or what sort of things that they've got to pay taxes on. I know you already mentioned it.
Yeah, no, I mean, that's a good
Because it's not income
question.
tax again. You're not paying that the same way you did when you took it out of your paycheck to get it there.
Well, potentially on some of the growth you are. So these are the taxes that you pay in an account, and everybody, I think that's on this call has bank accounts at least, and they get a 1099 or they've had some interest, some dividends that you have to pay taxes on. So the taxes are as such. If you have ordinary income and bonds, you pay ordinary income taxes on those on the interest of whatever your tax rate is. So if I have $100,000 and I have a 4% bond, that is $4,000 a year, I'm paying ordinary income taxes on that $4,000. So at the end of year one, I don't have $104,000. I have $104,000 minus the taxes I paid on that $4,000 of growth. So any interest, you're going to pay ordinary income taxes on that interest. Any, some dividends are taxed as at ordinary income tax rates, and some dividends are taxed a little bit more favorably. It depends. So you're going to pay taxes on interest at ordinary income. You're going to pay taxes on dividends as well. And then when you sell an investment, you have to pay capital gains tax on that. So if I buy an investment for $1 and I sell it for $2, I have to pay, based upon my tax rate, probably around 20 to 25% of that on that dollar of growth. And so those are the taxes you pay every single year. So if I have 100 grand and it grows to 200 grand because I had a great year in the first, whatever my investments did 100% return in one year, at the end of that year, I'm going to have to pay taxes on that 100,000 of growth in some way, shape, or form. Now, not every year can you say, oh, it's 25%, oh, it's 30%. Some years it might be less, some more, but there will be taxes owed, and your net after that year is not going to be, you're not going to have 200,000, you're going to have something like 175,000 or whatever it may be.
So I think that distinction is really helpful for listeners, especially knowing that, okay, in a taxable account, I could pay taxes from an ordinary income tax perspective or a capital gains perspective. It could be short-term, could be long-term. And there's also a difference between realized gains and unrealized gains, not to go too far down the investments rabbit hole, versus the things we're talking about today. This advantage of the tax-deferred or pre-tax investments is all that gets pushed to the wayside and to the future whenever you actually do access the money and actually take it.
Correct. And then, and Mark, I mean, just one other point, and this is kind of a little further down the road, but talks about how to invest, or talks about one thing that we do as advisors is help our clients invest their money in the accounts in the right way. So that means that, do you have what kind of bond should be in your 401k versus in your taxable account? Should you own individual stocks in your IRA versus in your taxable account? Or should you own different types of exchange traded funds and the different types of retirement accounts? And that's very important too. And that's really kind of the next step. But here you're just illustrating, why to the advantage of tax advantage accounts. Essentially, everything equal: tax rate, growth, investment return, period of time. If you are in a tax advantage account, at the end of the day, you will have more money in your pocket.
So I think I heard you just drop a little nugget about maybe investments 201 or 301, something like that. So be on the lookout down the line, right? Well, that's great. So hopefully that lays the framework and the foundation for everything and a good understanding for what we're getting ready to get into, which is looking at some different examples of tax-deferred savings opportunities for you. And you'll hear us talk about it from a couple different perspectives, including, let's say you're a business owner versus let's say you're an employee of a company, right? This applies to everybody, no matter what boat you're in. But what we've got here is a case study that we're going to walk you through. And this case study is about a 56-year-old business owner taking $120,000 of income. And think of that however you want, whether it's W-2 or distributions or anything else. That's their total take home as an owner. They've got a dozen employees with north of $500,000 in payroll. And the goal is to save money for themselves for retirement, reduce their tax burden, and also take care of their employees. I think anybody would agree that finding and retaining good employees is one of a business's largest challenges. So that's kind of what we're going to be working off of here. And as we go through this case study, we're actually going to look at 4 different examples, each one building a little bit more off the prior one. So just keep that in the back of your mind as well as we walk through these. All right. So one example of a tax-deferred retirement plan that you could have, or maybe you've experienced before, is called a simple IRA. And it gets its name because it is pretty straightforward. It's pretty simple in terms of getting it set up, in terms of administering it, and in terms of how it actually operates. And so in 2020, these are the amounts that one could potentially participate in, because each year the IRS updates the amounts that you can put away on a tax deferred basis. And so we'll just walk through this example to kind of get our feet wet here. Let's say you have a simple IRA, and you're able to defer, in this case, $13,500 of your own money, right? So whatever your paycheck is, you can defer $13,500 pre-tax from that. And then because you're over the age of 50, you can make a catch-up contribution for an additional $3,000. And then the employer, whether that's you if you're a business owner or just whoever you work for, makes a match as well. So in this case, for a simple IRA, the owner is getting somewhere in the neighborhood, what is that, $23,000 in 1 year put away on a tax deferred basis. And then what does that mean for the employees in this case, based on that payroll and how a simple IRA works? It means that you could, as an employer, have to potentially give about $15,000 to your employees as well. Also, that amount is reducing your total taxable income as well. So worth noting there. So again, a very straightforward example, but it's a starting point, and this is a very common type of plan that a lot of small businesses, in particular, that they have set up. And so, combined between the owner and the employees, you can see about $37,000 there that you'd be putting away and reducing your taxable income by. When we look at the breakdown of payroll, the owner's income is 19% of overall payroll, and the employees make up 80%, 81%. But then the contribution, this is how that contribution is broken down based on the numbers from the prior screen. So the owner, if you'll remember back to the previous slide, they're getting about $23,000 versus all the employees for that employer match are getting, I think it was about $15,000. So that's example one. Kenny, why don't you tell us a little bit more about this next one, which is a 401k with a profit sharing plan?
Yeah. Simple IRAs, just a Mark, gave it pretty much all. It's something we used to have here. I mean, they are, kind of your starter pack for establishing a retirement plan. It's the easiest thing to do. It's in the name. It's very simple. There's no administration. There's no nothing. You just sign up and you can have one pretty easy. They got some weird rules with it that if you've got one, love to help you talk through. But the next step then is the 401k and profit sharing. This is the most common plan. This is what most people who are in the workforce in the United States, they have. And so here are the rules from 401k. As an employee, if you're under the age of 50, you can defer $19,500 of your own money. Oftentimes people, a lot of times we get questions, well, what about with the match and all that? It has nothing to do with that. You can defer close to 100% of your pay up to $19,500. Has nothing to do with what the company puts in on top of it. If you're over 50, you're allowed a catch up of an additional $6,500. Okay, so that is $19,500 plus $6,500, and then on top of that, you can have either different kinds of matching. You can do whatever you want. I mean, you as an owner, you can have a very generous match. You can have no match. You can have somewhere in between. The most common is where it's a safe harbor plan and allows you to put a certain amount away, typically about 4% for your employees. And by doing that, by saying as an owner you're going to do that for the employees, you're going to be allowed to put in the $19,500 plus the $6,500 for yourself and not be subject to different rules and regulations that might not allow you to put that much in. So that's the most common safe harbor plan. And then on top of that, you can make a profit sharing contribution as an owner. It has nothing to do with actual profits of the company. It is just a formula that's used that allows you as an owner to put an additional 25% on top of the on top of your salary deferral capping it at a total amount cannot go in your plan. I believe if you're over the age of 50 for 2020, it's like $63,000 or something like that.
Hmm.
And so,
Kenny, did you just mention that sometimes there could be a cap on the deferral, or we've even seen a number of instances where people will get money back?
yeah,
Isn't that something?
yeah, it is. And so that has to do, the example I gave was the safe harbor plan. All right. If you have a safe harbor plan, you don't have to worry about that. No money's ever going to be sent back to anybody. If you do not, it's subject to testing, and it gets extremely complex. But essentially, if you make more than $135,000 in a year, you're going to be allowed to put in 2% more than the average of everybody who makes less than that. So if everybody who makes less is only putting in 1%, then if you make more than 135,000, you'll be capped at putting in 3% of your own money. And if you're putting in more, that's why people get it back. It's more complicated than that, but that's just kind of 101 there as far as as far as why people have a safe harbor plan. And
I think
so,
that's a great recap because, like you said, it gets very complex. There's all sorts of different rules that can come into play, and it also is very dependent on your plan design. So, if you're an employee and you've ever gotten money back, that might be part of the reason why. But certainly, we could help you answer that question for sure. And if you're a business owner out there, either contemplating setting up a plan, or you're also you have some confusion about that, we'd be happy to help you take a look at that and see how is your plan set up and how's it designed, and is it functioning how you want it to.
yeah. And so in the example that Mark gives here, right, there's a total of, a total amount going in for the owner of $51,300. Okay. And what does he have to put in to be able to do that for himself? And it's fortunate or not for it, it's just the reality of life is most owners are not going to want to put in a bunch of money if it's not advantageous, at least somewhat advantageous for the owner itself. So he gets of the total amount of 81,643, based on my quick math, it's about 51,000 of that goes to the owner. And so the question is to ask, the owner is going to be asking, well, if I just took that 81,000 instead of putting it in the retirement plan, how much of that do I get to keep? And if he's at a 40% tax bracket, of that 81,000, he's going to get to keep about 48,000 of it. Well, in this case, he's actually coming out ahead, because the $81,000 he gets to keep. What is the owners of that was 51,000 or something like that. I did that 51,000. So it cost him an extra 30. It cost him 30 grand to get his 51 in there, but he's going to have to pay taxes on that money if he didn't do it anyway. So he's actually coming out ahead. And so this is that next level. The simple IRA is kind of your most basic retirement plan you can establish. The next level is it gets into a 401k profit sharing. That allows you to put away $19,500 plus profit sharing plus match, and it starts to become an attractive feature for the owner. Totally depends on for the owner and for the employees certainly as well, because this is all just added bonus, extra money on top.
Yeah, no, that's also true. And so as we saw with the simple IRA, again, here's just the breakdown with payroll. That hasn't changed, but now the contribution is also pretty similar in terms of percentages. But as we know, as we've seen, the dollar figures are much larger. So that's example number 2. And then now we're going to take it to example 3, or solution 3, which is everything that we just talked about still applies. The only difference here is that now, if you're an owner, instead of taking that $120,000 of income, however it's divvied up, now if you've got $200,000 is what you're taking, then just the numbers, they change a little bit. And so again, we've got our deferral, our catch-up contribution, the level of employer match is larger due to larger income, and then profit sharing also now changes. Now, there's an interesting thing in this example here is that you'll notice the profit sharing actually went up, and the amount for employees actually went down. This is where it does just get into the plan design and how it's set up, and more specifically as well, what your census looks like for your staff and for your payroll. So it's not just as easy as a one size fits all, or this is how it works. There's a lot of different moving parts here, but this is just to show here again that you can build from one thing to another depending on what your situation is. And so in the last example, that number was 81,000. Now it's jumped up to about 88. But here again, it's more skewed in favor of the owner because of how things are working and because of what your salaries are. All right.
Yeah.
Here again, just the breakdown between of payroll and then of what the contribution is into the plan. So
Now, yeah, and I mean that's now you're saving money, right? I mean now it's actually you have more money. You are better off by doing this and giving your money to the employees, because here's what it boils down to: you're either going to give the money to the employees or you're going to give it to the government.
yeah,
Well, somebody's going to get it. You know, you can't. You don't have a choice of there's no C, none of the above. So somebody's going to get it, and this is why business owners do things like this for the staff, because it's so advantageous
right,
for
right.
everybody, for everyone. I mean, the staff as well.
Yep. Yeah. So what we just talked about, that those are examples of defined contribution plans, in the sense that, hey, there's a certain level that you can contribute, as we've explored. And there's some other examples that exist out there as well, but these are some very common and prevalent ones. Now what we're going to do is take it to the fourth and final step, which includes something called a defined benefit plan. And Kenny, do you want to walk us through this example?
Yeah, I mean, I'll do my best. So like this would be
I'll chime in.
okay. This is obviously the next level. This is for business owners. If you're a business owner and you're making, there's no right number, but $600,000 a year or more, something like that, and you are really trying to aggressively save on taxes, this is a phenomenal tool to use, and it's going to accelerate the amount that you can put away into tax deferred vehicles drastically. So we got limits as far as the limits as in regards to the 401k plan. 401k profit sharing combination are 60 over the age of 50. I think it's 63,000, 57,000 or something like that this year. It changes a little bit each year. And I've seen defined benefit plans that show the ability for owners to put upwards of $300,000, $400,000, $500,000 in 1 year into this plan, of which they do not have to pay taxes on in that year. So you're deferring that kind of income. You get to let that income grow, the same as I illustrated earlier. It's a great tool. Here's what you need to know about when it may be a fit. Your income is consistent. So you've been making good money for a prolonged period of time, because this is the kind of plan, it's incredibly advantageous from a tax saving standpoint, but it's like this in anything. The IRS knows what they're doing to a certain extent. They don't give you free lunches. If there's any, there's catches to it. So to do something like this, it's extremely beneficial for you and for tax savings and for the employees, but you've got to follow more rules. You've got to be consistent with putting the money in at least for 3 years minimum, 5 years probably better. So it's not something you can have one good year and just throw a bunch of money in and then quit doing it. You need to have that sort of consistent, steady cash flow. So great for businesses that have been established. The owner is making good money, and that money, that income is relatively consistent year over year. It doesn't have to be the same every year. Obviously business fluctuates, and certainly during times like this, it's fluctuating the wrong direction, but just have some consistency. You're going to be making, you at least you have the confidence you're going to be making money continually going forward. And
Yeah.
so the example here, Mark, walk me through the numbers because it's
Sure. And that's what I was just going to kind of touch on is that, we really could spend an entire hour talking about nothing but the cash balance plan and how it works and the different nuances to it. Kenny did a great job recapping it as far as how you should be thinking about it and if it may be a fit. But there's a lot to consider when it comes to something like this, because not only do you need to have the stable income and cash flow to be able to fund it, for about a period of 3 years. But it does have more administrative work around it just because of what's involved. Another key component to something like a cash balance plan that is worth pointing out is that it's a type of plan that we refer to as a defined benefit plan. So instead of funding just a specific contribution amount every year, what you're doing in this type of plan is you're putting away money now based on being able to fund a future benefit. Think of it as almost creating your own pension going forward for when you do retire. And so when we get to this concept, what that means is that we have more actuarial calculations, and it's really heavily dependent on what your census and your data looks like as far as how many people you employ, what their ages and incomes are, and a number of other factors. So this is something that we've helped a number of clients with great success, but it really does have to be the right fit. So, back to this in this example, when we layer on the 401k and profit sharing, which you're now familiar with, where we know we have deferrals and catch-up contributions if you're over 50 and profit sharing, then on top of that, you have this cash balance feature, as Kenny highlighted. It just increases the amounts substantially that you're able to put away. But it all depends on what those dynamics of your business are.
right. I mean, just like, so let me give you some examples of the businesses that it works best are where you have an owner and the employees are either hourly or they just don't make that much. That's where it can really, and they're younger. Perfect examples, dentist practice. The dentist is making a lot of money. The hygienist, they're not paid that well. They're young. There's typically a lot of turnover because you can make eligibility as such. Any independent contractor that has a consistent, steady business, whether you're in commercial real estate, whether you are in residential real estate agent, works great. Daycare owners. So if you're a daycare, a lot of the workers in the daycare are hourly and they're not very highly compensated and they're young and the owner's making substantial money. A great tool for that. So, where it doesn't work is even if you have a great business and, engineering firm is an example where everybody there is making good money and typically they're older, it may not work for the owner's standpoint because the cost might be too great.
Mm-hmm.
Just some examples.
But it's certainly something that could be worth exploring, dependent on your situation. Here, as we show,
Yes.
The vast majority of businesses and business owners do not have a defined benefit plan, but that's how it should be. That's for good reason for all of the examples that we're highlighting here. So let's just look at a summary because I'm a visual learner. I think it helps me. When we consider owner and employees, and then between the four various examples that we've looked at, this just helps you visualize and understand, hey, there's different opportunities that are out there. Here again, depending on what your situation is and what you're looking to accomplish. And again, whether you're an employee, it's important that you understand what plan you may have available to you and how that operates. Or if you're an owner, it's important that you understand, hey, there's ideas that are out there that may be better suited to me than what I'm currently doing. And that's what we hope to highlight for you here today. Anything else that you would add to that?
No, I mean, I don't think so. I think that it's a good summary of the different kinds of plans as a business owner you should be thinking about, or you should at least inquire and be aware. And as an advisor, I can tell you, it costs nothing for us to run a illustration to show you here's what maybe you could do, and whether it be a simple IRA to a a cash balance plan, or even, you can get very intricate in these cash balance plans. So whatever it is, just knowing what's out there, I think is the best, first step.
Knowledge is power. I think a wise man once said that. It might have been you.
I believe that was me.
Yeah,
Thank you.
that's right. Well, in the interest of time, we always try to keep these to right around 30 minutes. I think we're there. So here again, we hope that you've enjoyed this content and that it's been valuable for you. If there's anything that you want to see us cover, please drop us a line and let us know. We've gotten some great ideas from you already. And then here's where you can go to access all the previous information that we've been putting out. And just as always, we appreciate you being here. And if there's any questions that you have, you know where to contact us. And if there's anyone that's in your network that that's reached out to you, or who you think needs help, we never expect you to know what their situation is, but we do want you to know that we're always available and willing to help them in any way that we can. And so that offer is always out there.
Absolutely. Bye,
All
y'all.
right.
Have a great week.